Okay, so we've got the script here, Lithium-Gold paradox.
Mm-hmm.
And it really sets up this compelling contrast, doesn't it? Gold, traditional wealth, shiny, but maybe not so useful for the green future.
Right. Versus lithium, absolutely vital for the energy transition, scarcity soaring, the new oil idea.
Exactly. And it hits you straight away with that tension. What do you choose? The metal glinting in your safe or, the one that actually keeps the lights on?
It's a great hook. Sharp.
So let's dive straight in. The first area we want to look at is right at the heart of it all.
The paradox itself.
Yeah, the paradox, this core idea, this contrast between, let's say, practical value and trust value. We think there's room to really deepen the foundation here by getting clearer on the mechanism of financial value.
Okay, so while that core contrast, the future critical element versus the inert lump in a vault, it's powerful, definitely a hook.
Right.
But the argument maybe stumbles a bit because it kind of implies the financial system is just slow or stuck on tradition.
Which feels a little too simple.
Yeah, it oversimplifies how markets actually behave. The real weakness, I think, is that it doesn't explicitly tackle the fundamental reasons why these very sophisticated financial markets resist seeing essential industrial commodities as, well, reliable stores of wealth.
But isn't that the whole point of gold? It's stable, it's traditional. Why does the average investor, when they're worried about inflation or war or whatever, why do they still reach for the inert thing instead of the element that literally powers the future? Seems counterintuitive.
Well, they reach for it because what they need in that moment is immediate, global security, and, crucially, fungibility.
Fungibility, okay.
A gold bar is instantly liquid pretty much anywhere. It's a known quantity, accepted in any market, carries basically no operational risk for the holder.
Huh.
So the way forward here, the suggestion, is maybe incorporate a brief sort of analytical section, something that tackles these core economic hurdles lithium faces if it were ever to become a true store of value. Go beyond just saying, well, people aren't buying it in a crisis. Explain why.
That feels vital. Because the listener, they get this stuff. They need to understand the structural friction that makes gold the default, even if its actual utility is, well, zero for running a car.
Precisely. Think about it. Compare trying to trade a standard, recognized gold bar during a panic.
Easy. Relatively.
Right. Now compare that to trying to sell, say, a ton of high-purity lithium carbonate. Or worse, a really complex long-term lithium mining contract.
Nightmare. Who's buying that on short notice?
Exactly. These industrial materials are complex. Purity varies, storage is a hassle, trading needs specialized contracts. Huge volumes. It's just totally inaccessible for the average person looking for a simple safe haven. It doesn't have that instant universal trust factor gold offers when things get really unstable.
Okay, so framing it like that makes the market's preference for gold less about being old-fashioned.
And more about logical, structural requirements for a crisis asset. Yeah.
Which actually makes the paradox you're setting up even stronger, right?
Absolutely. And one more thing on this point, you really have to touch on technological risk.
Ah, good point.
Gold is, well, gold. It's permanent, chemically inert. Lithium? What if solid-state batteries really take off? Or sodium-ion tech becomes viable and cheaper?
The whole demand picture could shift dramatically.
Fundamentally, that potential for technological obsolescence makes lithium, despite the current squeeze, potentially a poor long-term financial bet. Acknowledging that risk, that counterfactor, it actually strengthens the paradox. It shows why gold might keep its financial crown even with zero green utility.
Okay, that makes a lot of sense. Let's shift gears slightly. The macro risk. The piece correctly points out we're swapping one dependency, oil, for potentially a much narrower one, right? Rare earths, lithium. The new bottlenecks. Yeah, and I see where it's going, but we need to really nail down the claim that this new bottleneck is geopolitically more dangerous than the old oil one. That needs solid backing.
Okay, so that critique, moving from one dependency to another, it's highly relevant, super important.
Definitely.
But the material could give more context to really support that claim of increased danger. The weakness, as I see it, is that it states resources are concentrated only in the hands of a handful of countries. Kind of states it as fact to build the crisis narrative.
Right.
But then the text immediately pivots. It starts talking about how mining is dirty, slow, costly.
And loses the geopolitical thread.
Exactly. It shifts away from the geopolitical risk, which is the main source of that narrower bottleneck danger you mentioned.
I agree. If the focus drifts too much to the environmental side or the extraction difficulties, which are valid points but separate, we lose the power of the supply chain control argument.
We do need to keep the lens tight on who holds the levers of global control.
So what's the suggestion?
Focus the bottleneck discussion very specifically on the concentration of refining and processing capacity, not just digging the stuff up.
Ah, the refining.
That's where the high-value, hard-to-replicate control point really sits. And that's what paints the clearest and, frankly, more terrifying geopolitical risk picture.
That's a critical distinction. It's not just about who has the raw ore under their ground,
No.
but who controls the incredibly complex, often polluting, chemical processes to turn that ore into battery-grade material. How did we even let that get so centralized?
And that highly specialized, energy-guzzling refining infrastructure, often taking advantage of looser environmental rules elsewhere.
While the West outsourced it.
Pretty much. Outsource the capability to save on costs, compliance headaches. So when the script talks about that handful of countries, it needs to explicitly link the risk beyond just extraction. It's the control over that specialized conversion step that creates an economic vulnerability potentially far greater than just having reserves in the ground.
So the processing concentration is the real fragile point. Okay, but we need to maybe quantify that consequence a bit. Is this processing bottleneck really more volatile or less diversified than, say, historical oil supply chains? That's a big claim to make.
It's arguably much more consolidated, especially in terms of that very specialized processing know-how and infrastructure. It creates single points of failure that the global oil market, even with OPEC, never quite had in the same way.
Okay.
Think about it. Political instability or just a targeted regulatory change in maybe one or two key refining hubs could trigger an almost immediate, widespread economic shockwave for EVs and battery storage.
Right, much faster than turning off oil taps, potentially.
Potentially. And that inherent volatility really underscores why, for some investors, gold's promise of boring stability still looks so appealing, even when lithium is screaming future.
Got it. Okay, let's talk narrative impact. I actually really liked the use of those emotional, high-stakes scenarios, like the idea of an EV battery costing as much as a small house.
Yeah, that grabs you.
It absolutely does. Creates real engagement, urgency. But now, maybe we need to refine those crisis scenarios just a bit to maximize the credibility, the analytical depth, without losing that gut punch.
Exactly. The drama works, it pulls the listener in brilliantly. But the weakness, potentially, is that those final questions, especially the really extreme cost ones, they could tip over into sounding alarmist, maybe, rather than purely analytical.
And lose the sophisticated listener?
Yeah, they might just dismiss the whole scarcity problem as hyperbole if the worst case sounds totally implausible. We want the intellectual weight of the piece to land just as hard as the emotional impact.
But I worry, if we pull back too much, dial down those extreme hypotheticals, do we lose the urgency altogether? The listener kind of needs to feel the potential scale of the crisis to really care about the gold-lithium paradox in the first place.
Oh, we keep the urgency. Absolutely. But we ground it. The suggestion here is to frame those extreme scenarios explicitly not as forecasts, not as guaranteed outcomes,
But
as the maximum potential risk if those current resource constraints, that huge, like 500% production increase needed, if those constraints are not met. Keep the high stakes, but root them firmly in analytical possibility based on current trends.
Okay, that makes sense. So we present the potential catastrophe, but maybe immediately follow it by showing we've considered how it might be avoided? Demonstrates more rigorous thinking.
Exactly. So how do we do that concretely?
Well,
After posing that really stark question, the EV battery costing a house, you could immediately follow up. Ask something like, what role could innovation play here? Things like dry electrode manufacturing or breakthroughs in non-lithium chemistries or, massive global regulatory pushes on recycling. How could those factors work to prevent that worst-case outcome?
Or maybe frame it as a question, like, if this cost trajectory holds, how quickly must global recycling capacities scale up to break that curve? Something like that.
Perfect. That kind of balance shows the listener the critique isn't just sounding an alarm. It's considering the whole system, market responses, innovation cycles. It elevates the argument from just a warning to a more insightful economic observation. Makes the whole thing feel more authoritative.
Right, more balanced, more credible.
Precisely. And then for the ending. Instead of just landing on that simple binary choice, the shiny metal or the power source,
Yeah?
maybe pivot the final reflection. Turn it towards a more complex, long-term challenge. Something like, how do financial mechanisms themselves need to adapt? How can we start valuing resource resilience alongside traditional ideas of wealth and stability?
Ah, that's a much bigger, more thought-provoking question to leave him with.
Exactly. That's the complex final thought that will likely resonate more deeply with this audience.
Okay, this has been really helpful. It's clear the material is strong, tapping into real scarcity, real geopolitical tensions.
Definitely a strong foundation.
So, to maximize the impact, the key actionable steps seem pretty clear now. They should really bolster the piece's credibility.
Absolutely. So, just to recap, we'd encourage focusing on maybe 3 core areas. First, really deepen that paradox. Explore the why behind financial value, liquidity, fungibility, and don't forget that technological risk for lithium.
Right. Make the market's logic clear.
Second, strengthen the geopolitical angle of the bottleneck. Sharpen the focus onto refining and processing capacity. Not just who has the raw materials underground. That's the real choke point.
Got it. Processing, not just extraction.
And finally, make sure those dramatic crisis scenarios land with analytical weight. Frame them as maximum potential risks and then immediately show you're thinking about the counterfactors, the innovation, the recycling, the mitigation strategies. Balance the alarm with analysis.
Balance is key. Maximum risk plus potential solutions.
Exactly. If you implement those high-level suggestions, I think it'll make a significant difference. We are genuinely looking forward to seeing the revised version. Please do submit it back for a follow-up critique when you're ready.
Excellent. Thanks very much.